What a powerful rally. Can it last? This is Tom Aspray with the Viper Report Market Wrap video for the week ending April 17th. If you have a retirement account that you haven't looked at in several months, this will be one of those weekends when you'll be pleased by what you see. It was an amazing rally last week. You can see this Dow Industrials, NASDAQ Composite, S&P 500, and the mid-cap all moving sharply higher. The week's performance: transports up 10%, over 10%. NASDAQ 100 up 6.2. Russell 100 or 2000 small cap up 5.54. S&P, etc. Even the was lower, down 2%. Even gold had a rough week, but it was still closed higher on the week. If you look at the 1 month, it's even more impressive. 24% up in the transports, 10 in the Russell, 7.6 for the NASDAQ, 6% for the S&P, industrials 5%. It's been an pretty incredible performance that not many expected, unless you were following the advanced decline lines. As we'll show you in a few minutes, they've been skyrocketing to the upside. If you drill down a little further here on their summary page, you can see these are the amount above the 20-period EMA. Obviously, we tend to favor buying when it's down near the 20-period EMA, and or selling if it gets too far. Transports up 11.8% above that 20-period. Going down here, you can see, the NASDAQ 100 up 6.38. If you look at a chart of this, here's a chart in the ACP mode showing the NASDAQ 100. You can see over here it's up 6.38%, and it's been bumping up its stark bands for the past week, really, Tuesday, Wednesday, Thursday, and Friday. And we all know that means it's in a high-risk area to buy, a lower-risk area to sell. If you look at the weekly chart here, we'll see the same thing. It moved above the weekly band this week. So going back to the daily, you can put this into perspective. If you increase the scale, you can see that up 6.38 way back in early May, as the market was also taking off, it was up over 7%. So many people would look at this and go like, oh well, rally's over. But other more seasoned technicians, I think I would put myself in that case, would say that this is likely a kickoff rally that'll last a while. You can see back in here, we did move sideways to lower for the next week when we got that extended. That's kind of what we're looking for right now. Let's look at some more charts. Looking at the weekly chart of the NYSE Composite, you can see a strong close. More importantly, the AD lines, of course, they broke out in May, had this great move up 2 weeks ago, as I pointed out, that pulled back to their moving averages and given new buy signals, and those buy signals have had a pretty dramatic impact. When you have a sharp rally or a sharp decline, it's often handy to look at the put-call data. So this is the total put-call, CPC. It's down to 0.66. And the index is also quite low at 0.85. That's obviously going to change next week. We hadn't seen too many spikes in those numbers, but that seems likely in the week ahead. I often talk about the VIX and the VXN, the volatility measures. They, as I pointed out at the time, they had a rally back to the declining moving average early in April and have since fallen dramatically, broken below support, but they're overdone. So I would expect to see them, rally back up, towards their moving averages in the next week or so. They shouldn't get above these early April peaks. We looked at this chart a few weeks ago to point out the fact that I really didn't think the decline we had from the late February highs here, you can see right around in here, up until the recent lows was the start of a new bear market. A lot of people did. But one thing I have always used and it's been very helpful over the years and decades is to compare the slope of the AD line here in purple, this is the NYSE All, to the price chart. So in start of a bear market, you expect to see that the AD line is acting weaker than the prices, right? So more stocks are declining. You can see here, you know, the SPX, the S&P 500, you know, had dropped below this low here, but you can see with the AD line, it was much higher. Okay, so that meant that the decline, you know, in a few stocks was pushing the prices down more, and the overall stocks were not in a bear market, in my opinion. And of course, now we've made new highs here, so that supports that. Down here, we also have the percentage of stocks above the 20-day. We got down into some of these zones. I find the AD lines more valuable, but sometimes you get some nice signals. If you zoom in, if you have this chart, you can see that, you know, we had a little bullish divergence here at the lows, and, you know, the stocks above the 50-day, you know, got down to 20, and then stocks about the 200-day, you know, got well below 50 and crossed back above it, and they also appear to have, you know, have completed their decline, looking pretty strong right in here. The daily chart of the SPY shows you that on Friday we got right up to the monthly R2. We had a high of 612.39, quite close to the April 8 R2 resistance level at 712.92. Of course, we're off of the, you know, you can see this converging support now. You know, the 20-day EMA, you know, had been below both the 50 and the 200-day, and now we're back above the 50 and back above the 100-day. Of course, these, you know, do represent good support down here. You'd also be looking for support in this 690 to 700 area. We spent a lot of time in there, so that's probably the area we'd be looking to add to long positions. S&P AD lines, they had been diverging earlier in the week, so they were down in here below the highs. We took care of that last week. You can see the sharp increase in the stocks only, you know, to a new high above that one, and the all also at a new high. In last week's action, it was a growth-led rally. You can see the ratio of the IWF, that's the Russell 1000 growth, to the IWD, the Russell 1000 value index, rose. Okay, this suggests that, you know, this trend line break, we had quite a move here, you know, from really at the start of you know, November, you know, to a week ago was value was outperforming. Looks like that may be changing here. You know, the weight of the evidence is, you know, probably 60-40 in favor of growth, but you know, it's not. We don't have the formations like we did in early 23, where, you know, you had this perfect setup of the MACDs, very bullish divergences, lower low in the ratios, higher lows in the MACDs. Now they look like they're turning here, but, you know, we don't get those formation of those bottoms all the time. If you look at the rally in terms of IWD, suggesting that the rally may have legs is the fact that the relative performance on the IWD value has dropped back to its moving average, and on the other hand, the OBV has moved above its moving average. This suggests that it's may no longer be leading the S&P. If you look at the QQQs, finally broke out of this range here pretty impressively, and you know, we had a false break to the downside. I don't think this is a false one, mainly because, you know, while the AD line did make a marginal new low, you know, with the averages here at the end of March, you know, it's been very powerful since that point and exceeded well above the resistance there. And the RS on the Qs also has completed that bottom formation we've been talking about since February. You know, started around in here and finally broke through that downtrend. The weekly chart shows a pretty impressive breakout. Just 3 weeks ago, we came pretty close to the yearly pivots, which is at 549.40, and now we close about 100, almost 100 points above that. You remember, you have the using the yearly pivots, you get a weekly close above it. That's indicative of a positive trend. You remember these levels here are derived from all the trading in 2025. So it becomes pretty significant. The first target is going to be in the 698 area. That's the R1 based on the yearly. You can see the S&P or the NASDAQ 100 AD line, had turned back to positive, as we noted 3 weeks ago, and held its support. And the RS on a weekly basis also has been very strong recently. Nice action in the number of stocks making new highs, new lows. We've been following this. We see how it really declined. We had this divergence, but the way I look at these numbers is that we need to see a breakout, in the new lows to give a sell signal for the overall market. We got close in March, but we didn't. You can see now we have 527 new highs, very close to the peak we made in January. New lows down to 53. If we look at it on the New York Composite, you can see not as impressive a number of new highs here, but certainly new lows now at 1,195, positive. So it's still diverging in here. So, in a week or two ahead, we'll be watching these numbers. We watch them day in and day out for seeing any sign that that's changing. As the market's correction was ending, we looked back at some past T&J watch list reports, finding that the number of stocks above their quarterly pivots, the number of weekly buy signals, had dropped to very low, i.e. oversold levels that we'd last seen in April of 2025 as the market was cratering. So quite a bit different this week. Energy, weekly sell signals, Vanguard Energy, XLE, XOP, all negative at this point. I've been following crude oils for since the early 80s. I'm not sure that the rally is over, and of course the weekend we have some new Straits of Hormuz news. So it's a volatile market. The bottom and unfortunate line, in my view, is the fact that what's gone on so far is likely to impact oil prices for months ahead, and unlikely for them. We're back to $80. I wouldn't think we're going to get to 60 in the near future. I hope we do. Tons of new weekly buy signals in most of the ETFs. I just hit these. We have Dow Industrials, China, GameStop, game leaders, high yield bonds, biotech. As I said, the IWF, that's the Russell, 1000 growth, social media stocks, consumer discretionary, you name it. XLC, XLF, XLY, XLME, XRT, and the dollar. So lots to look at there. And if we look at down, here, now we have 82.5 above their quarterly pivots. This is flashed back to positive, as I said a couple weeks ago. And you can see that, FDN, internet, new weekly DTS, as I said, IWF the growth, and XLY also. And if you look for value, 80% growth, 72%. So that's just kind of flipped. For the last 4 to 6 weeks, we've had a slightly higher percentage of value ETFs above their quarterly pivot. Now we have a slightly lower. And you can still see, there's still some positives here. The financials here, and the KBE and KRE, that are two bank ETFs, they're still positive. So we'll be watching those. If this at this point, I'm not looking for a huge imbalance between value and growth, but that's possible. Certainly, this is what you expect to see. You know, all the short ETFs are in the sell mode, below the quarterly pivots, weekly negative signal, daily negative signal, while the inverse long and multiple inverse, all positive, TNA, TQQ, etc. Looking at the sector report, market gauge is bullish, 69.4%, are above their quarterly pivots, and you can see the big slide in energy. That's even that suggests that probably energy stocks have topped out, but you really would expect to see a secondary high up in the air, in the weeks ahead or months. So we pretty much have no energy position right now, but if we see some reliable, short-term signals, that may change. Materials a little weaker than we expected, but still a bunch of the chemical companies we're looking at, and some of the multinationals that sort of a mixed bag. Some are working out, some are not doing as well as I'd like. In the industry, you can see what it's dropped also down here. So like Honeywell gave a daily sell signal, as did a bunch of the defense stocks. Hopefully the hostilities are over, but until we give a 3-day, I'm not yet ready to say that their rally is over. What does look good? Consumer discretionary. Finally, we talked about this last week. It looked like it was forming a bottom, so we've moved above. Green is the fast-moving average, moved above the blue, which is a slower one. That's the sign of a bottoming here. Home Depot, Lowe's, Tesla, McDonald's, Nike, are some of the ones that are looking good. Consumer staples, not so much. You see lots of red there. Coke, Mondelez, General Foods, the smokers, etc. And Costco, is also DTS and 3 DTS. Walmart's still hanging in there, as is Target. Healthcare, the healthcare ETF is still holding support. The relative performance is not looking great here, and you can see that this is pretty much Lilly and Bristol Myers are a few of the bright spots. Financials, the relative performance chart is not that interesting right in here. I think it still looks better on the banks, and you can see some of the banks have had some pretty good moves, and Wells Fargo was disappointed, but a lot of the rest of them have held firm. BlackRock, etc. You can see weekly DTS in Visa, Master, American Express, and BlackRock. Technology, of course, been the big winner. Apple 3 and weekly. Microsoft is finally in the positive, as is Oracle. Chart here looks very strong, so it looks like it's going to be another growth-led rally. Of course, we get their earnings coming out here in the near future. Also, some encouraging signs from communications. It's been a pretty much downtrend here. You can see that support levels in the RS are important. So we got right back to that low we had in February, and so Charter Financial, CSA, Eaton down here, and Meta also shows a weekly positive signal. 72% bullish, so that's what we like to look for when we're doing buying. Utilities, have been hit down to 50%. So, the longer term trend analysis hasn't given up on the utilities yet, or on the REITs for that matter, even though the RS chart looks a little sloppy here, and we still have a bunch of green in terms of the major REIT. Next week, retail sales on Tuesday, business inventories, pending home sales, then jobless claims and some PMI data, and consumer sentiment for the end of the month from the University of Michigan on Friday. Well, hope you have a good week in trading. Once again, you can follow me on Twitter, as I usually tend to update my short-term analysis, and if you'd like to subscribe to any of our services for specific recommendations, we'll be looking for good buy levels here in the week ahead. Thank you very much for tuning in.